Hi, I'm Toby.
And I'm Nick.
And we're here bringing you the Pure Property Podcast with Track Capital, where we talk about everything property and property investment. Now, the aim of the podcast is to provide you with bite-sized chunks of our industry insight and knowledge to help investors invest intelligently. So it seems like we have blinked and this year has already passed us. We are in December now. It's getting very cold outside and we are fast approaching Christmas. It is very scary, to be honest, how quick this has all gone.
Yeah, I'm sure some people would be pleased to see the back of 2020. We're, as a business, luckily still busy at the moment, and I'm sure we will be right up until the last minute. So, yeah, looking forward to seeing out December and then cracking on with 2021.
Yeah, got those New Year's plans to get on, all the New Year's goals and New Year motivation, but we won't think about that too yet. We've still got a little bit left of 2020. So enough about that. Let's take a look at what we are going to be discussing this week. And we are bringing you our top 5 tips for what to look at when reviewing investment deals.
Exactly. So these are 5 overarching principles that we want to think about when we're assessing investment property. So to kick things off then, the first factor we'd recommend you looking at is the general location of the property. So underpinning that will be the investment fundamentals, which are ultimately present nearby. So we want to think about things like transport. How well is the property connected for tenants? Now, to look at that, obviously you would just look at the Google location and see if it's nice and convenient. Is it under a 10-minute walk to the local bus stop or train station, etc., etc. A couple of other things to think about on the fundamental side would be employment, what major corporate employers are nearby, education, you can go online and see what major universities are present, because that's all ultimately going to drive tenant demand and create a real atmosphere in the city. And then a couple of other things to think about would be regeneration, how much local investment is going into the city. You can check out the council's website, look at the government initiatives, what are taking place, looking at both private and public investment, because that obviously forces values up in the long term, which is something we want to consider. And then another big factor which you want to look at in places like or the key regional cities, if we're doing things like short-term lets or we're relying on people coming to the cities, are social events. So although it hasn't been too present in 2020, moving forward, sports, leisure, entertainment, nightlife, it all adds up to make an overall attractive package for tenants. And just to finish off on the location then and the investment fundamental aspect, another thing we want to think about is the market performance. So how is the property market in the local area being hyper-focused, expected to perform over the next 5 years? So we look at websites and companies such as JLL, Savills, HomeTrack, Zoopla, Rightmove. In all these different locations, you can see what's the forecast capital growth and appreciation rates, and you can really give yourself a good idea of what the average values are doing in the area, and which will in turn enable you to make an informed decision. So that's the first point we would think about, and that's location/investment fundamentals. Toby, anything to add on that?
I would just add, really, when looking at that, Google is definitely your best friend, because I think you can find a lot of answers to those points that you have addressed on Google and cross-reference against these companies. And also, if you've been shown a specific deal, they might be quoting certain parts of data. And again, it's always a very good idea to cross-reference that.
And yeah, I think that's a good point. At the end of the day, we want to make sure we're doing our homework and doing proper research. So going on Google, looking at all the points we've mentioned is certainly a great way to get started. So that's location and fundamentals. Moving on to the next one then, Toby.
Yeah, and quite an important factor that we have to consider when analysing and looking at an investment deal would be the financials. Now, there are 3 main things that you will look at when looking at the financials. So initially, we look at the gross yield. So that's a quick and easy way of looking at your returns. Then once we figure out the gross yield, if that's acceptable and we haven't chucked this deal in the bin because the returns look awful straight away, we then go on to looking at the net yield. So this is where we take into consideration all of the costs. So for example, if you're looking at an apartment, you would then have to take out of your rental income, your service charge, your ground rent, your management fee, and that would help give you a net yield. Also, if you're using a mortgage, you would take that cost out as well. Once we've then looked at that and we are still seeing it as an acceptable deal, you would then go on and look at the ROI, which stands for return on investment. So this is also known as return on capital employed, because it's where we look at all of the money that we have put into the deal and what our returns are for that. So that will factor in such costs such as your solicitors, your stamp duty, if you've had to buy furniture, if you've done a slight refurb, etc., etc. These are all costs that you would consider, plus more, plus others, and that would give you the true return on investment.
Yeah, I think there's many ways to sort of measure the financial success of an opportunity. So those are a couple there: gross yield, net yield, return on cash employed. I've also seen return on cash invested, where you're just looking at the overall return on the cash sums that you've put into the deal. But the main point is get your head around the financials of the deal, break it down, treat it like a business plan, and look at the financials in detail to make sure it's a really robust opportunity there.
And if you do want simple calculations, you can find those online to work out all of those. You can also find spreadsheets that help do that for you. So Nick, why don't you introduce us into our next tip to look at when considering investment deals?
Sure. So moving on then. So the next one is the overall product or type of property. So we've obviously looked at the location, the investment fundamentals, the numbers, etc. But we want to be considering the type of property that we want to go for as well. Now, for investment purposes, it might not be the case that you're as fussy in terms of getting the right view or getting the right size, but you do want to consider the tenant demographic, who's going to potentially rent the property. So are we going for city centre apartments? Is it going to be a 1 or 2 bed? Are we going to try and find one with a balcony and a view to pay a bit more of a premium but demand a higher rent? Are we going for something a bit on the lower side, outside of the city centre? Something that maybe requires a bit more work. How are we going to finance the deal? Are we going to be happy with a studio apartment, or do we want to make sure it's definitely mortgageable? So there's a couple of things to think about, but at the end of the day, we want to try and narrow down the type of property and the type of products that we want to invest in.
Of course, things such as finishing, furnishing, the type of property, as you're mentioning, these are all things that will affect your rental price and also your sale price as you come to sell ultimately as well. So definitely an important thing to factor in.
Yeah, it's a key point. The reason why you want to look at that is to make sure that your return on investment, your rentability is going to be suitable, and overall it's just going to make for a attractive investment in the long term. So that's hopefully another factor for you guys to think about. Now let's move on to the next one.
Yeah, probably sort of falls in line quite well with what you've just spoken about. And the next thing we look at, and our next tip to consider, would be demand and comparable evidence. Now, demand especially will be something to do with the product itself, because the type of property you are purchasing will determine the type of demand you have. So if you are buying somewhere on the outskirts of town in a small suburb, you might be looking at a family. If you're buying in a city centre, you'll be looking at working professionals. If you're buying near a university, you might be looking at students. So a very, very good factor to consider. Also, when we look at demand, we want to look at, is there a lot of competition in the market? So is the market flooded? Again, if you look at a city centre, next to the developments that you're considering purchasing in, is there 10 massive high-rise blocks of the exact same property that are offering the exact same rental attributes that you are? So again, this is going to be very competitive. So when you come to try and find a tenant, there's a lot of competition out there. That could potentially drive down the price, and it could also leave you with a longer void period than that you might expect.
Yeah, it's a good point. So competition, one we consistently sort of look at and consider, because most of the developments that we market as a company are within the city centres. So I would think the only bit of advice I would give there is you've got to get a balancing act between buying a development that's in the city centre and might have a bit of competition if there's, a good supply of property coming through the pipeline and being built out. But at the same time, you want to look at a city level and see how much demand is there for housing for this type of property. So it's almost two-sided in terms of the considerations on the competition side of things.
Correct. And also it comes on to the next point of comparables. So when you do look at your competition, it can be absolutely fine to have 3 blocks of apartments next to each other as long as they're all renting out, because if the demand's there, it's not an issue. That's
Exactly.
why we would definitely say go on to portals such as Rightmove, Zoopla, have a look, type in the postcode, maybe do a quarter mile, half a mile radius, look at the rental properties available, but then also make sure you tick the box for let agreed, because you can see how many are on the market and how many are also let agreed. So bad situation would be you type in the postcode, quarter mile radius, and you've got 100 properties on the market, all been on there for 6 months. That would tell you that demand is very low. It's going to be hard to rent this property out. A good scenario is you type in the exact same thing. You type in the postcode, the radius, and you come up with 10 properties. 9 are all let agreed, and there's only 1 available. That tells you that demand is high. That also is what you would do to look at comparable evidence for the rental price. So if you have been told a specific rental price, go on to Rightmove, go on to Zoopla, check the area and check that a 1-bed apartment, for example, is renting for that price. Also, think of your exit strategy. Think of the price you're paying. So if you're paying X amount, look on Rightmove. Is it a fair price for the market comparables? Look what else is on the market at that price. Again, tick the box for sale agreed. Are properties selling for that price? Bear in mind, if you're buying a new property or a new build, there is going to be a premium, so they might be slightly higher priced. So don't be too concerned if they come in slightly higher. And look at how many properties are sale agreed, because that gives you an indication of the demand for properties for sale. Because as you know, at some point in the future, you are going to be potentially looking to sell this property on. So you want to make sure that people are wanting to buy there and live there or invest there. The other way you can do this as well, which is always a good idea if you have the time, get local advice. Call an estate agent. Let them know where you're looking at. Ask for their perception of the area, what they are seeing in demand for sale and rental. If you know somebody in the area, maybe ask them the question, what do they think? What's their thoughts on that place? These are all good ways and fairly quick. Don't get me wrong, they might take some time, but it's a good way of getting an idea on what your rental property is going to be doing and what demand is going to be there.
Yes, certainly. I think there's some really, really good points there. So let's just unpack that again quickly and summarise. So in short, we're saying look at the comparables for both when you're purchasing the property, potentially for your exit, but also on the tenant and the rental side as well. If you can, don't be scared to pick up the phone and speak to a few local agents, both on the letting side and on the sales side. But in essence, what we're saying is don't just check there's a train station nearby and then that be everything that you do. Try and go into a bit more detail. And again, it goes back to doing your research and becoming really familiar with the area. You can potentially go even further. We've got lists, due diligence checks and lists that we would look at that are 50 points long. You can look at things like the pipeline of development happening in the area on the planning portals, etc. So there's a lot you can do, but if you get the comparables right in terms of the lettings and the sales, and then you look at the demand in the area, you should be absolutely fine.
Yeah, great point, and thanks for summarising that for me, Nick. Why don't you come on to our 5th and final tip that we would give to people when looking at property investment deals?
Yeah, so far, hopefully we have given some quite specific advice, individual points that you can look at, you can check out, and you can make sure they suit what you're looking to do. Now, in this one, it's a bit more of an overarching sort of principle. So this is just basically making sure that the property fits in with your strategy and your overall purpose and objective. You've got to say to yourself, why are you buying this property? Is it to achieve consistent rental income? is it more of a focus on appreciation in the long term? Do you want to add value and refurbish the property to try and make a quick profit? So these are all different things that you can think about. And we're just saying to you, make sure that the properties that you're looking at and you're reviewing are in line with that theory. So if you wanted to focus on getting cash flow as quickly as possible, you're not going to want to look at properties which have a 2-year construction time frame off plan. And it goes the same for if you're potentially looking to release equity in the future. You want to be making sure you're looking at mortgageable properties, etc., etc. So the key point there is just to make sure, yes, we can look in at location, financials, the product finish, the demand, comparables, but we want to make sure the actual property strategy is sound as well moving forward.
Yeah, I think that's a very good point. Strategy and purpose is very important. I think sometimes some people can get caught up by the numbers, see attractive returns and want to go sort of all guns blazing into the property without actually thinking about it fitting their strategy and their purpose. You don't want someone to present you or come across a property which is a very good flip, needs a lot of work, will potentially get a quick profit. However, if you are looking for a long-term yield and a hands-off investment, that is completely the opposite direction of your strategy. It might look good in terms of the potential quick capital that you can earn from it by flipping it, but realistically, if you aren't hands-on, you haven't got the time to do the planning and project management, and you want something long-term, that really isn't for you. So you would want to just pass that deal straight away. And like I said, it's quite easy to get caught up in the headlights of an attractive property deal that doesn't actually fit your strategy.
Yeah, and there's plenty of options out there. There's an endless supply of property deals, new opportunities coming to the market consistently. So there's no reason to rush and, take the time to go through these checks. By doing so, it'll put you in the best position to succeed. Now, just to summarize then, and make it really, really clear, these are overriding principles. They're key sort of guides and general things that we can look at. When we as a company are taking on a new build development from a developer, we're going to have a much more robust and extensive list of individual things we want to look at in terms of the finance, the construction, the build timeframes, how they're managing it, the contract terms, etc., etc. But what we're trying to do today, and the purpose of this podcast, is to give you a couple of really, really broad points to think about, which would enable you to do your research and do your homework and put you in the best position.
Exactly. I would sort of summarize this as being your first plan of action. When you come across an investment or you're considering investments, this would be the first process you would go through to look at deals. Once you then find the right deal, I would definitely recommend going that bit further, but there's a lot more stuff you can do on that.
Good stuff. So just to recap then, guys, the top 5 or the 5 tips we've given today or key areas of consideration are looking at the location and the fundamentals nearby the property, looking at the financials and digging down into the net yield, the return on investment, and just make sure your money is going to be working for you successfully. Looking at the product, i.e. the type of property, the finish, the size, and just your general type of house that you want to purchase. Looking at the comparables and demand in the area, so on the rentals and the sales side, and just check it's not being in competition with too many other schemes. And then finally, just making sure it fits in with your strategy and your long-term investment objectives. Anything to add there, Toby?
Yeah, those 5 are the top ones obviously we've picked. The other point which kind of follows on from this is what we do say to a lot of our investors and our clients is don't get too hung up on what we call analysis paralysis, because sometimes you can find yourself going into so many rabbit holes, looking at so much data, so much research. It stops you actually making a decision and investing. So just be cautious not to get caught up in the analysis paralysis, as we call it.
Yeah, you don't want to be over analytical. And again, at the end of the day, if you do find something that ticks the boxes for you and it's safe and secure, then you need to take action and, start building your property portfolio. Don't wait another 6 months and lose all that income in the meantime. So if it ticks the boxes, if it's safe, if you generally think it's, a good opportunity, then we always encourage investors to go for it. Okay, so hopefully that's helped today. Toby, do you want to let everyone know what we're going to be looking at next week?
Yeah, next week we have got the topic of remote investing. So we're going to be talking about investing hands-off, not having to be there in person, and investing remotely.
Yep, so that will go for both UK domestic investors who are, investing in places like Manchester, Liverpool, but they might live in London, for example. But also there'll be a lot of content there for overseas investors. So things to think about from that aspect, which can affect all property investors as well. So hopefully that's going to be really useful.
Yeah, excellent. And we look forward to seeing you again next week. I'm Toby.
And I'm Nick.
Take care. Bye-bye.